Welcome back to Hexen Studios. We have Correct Capital here today, where trust matters. We're going to talk about financial awareness, financial understanding, and we're going to dig in and figure out who these guys are. So let's introduce ourselves.
Yes, Scott, pleasure to be here today, and I appreciate you all having us.
You're welcome.
My name is Jordan Korte, and I am an associate advisor at Correct Capital. I'd like to give you a little bit of background about myself and how I found Correct Capital. So my journey started back in 2018. I attended Mizzou, go Tigers, of course. And ultimately, going into Mizzou, I knew that I wanted to pursue a career in the financial industry. I'd always been passionate about finding ways to accumulate wealth, with my personal goal being to have the flexibility to retire early. So during my journey there, I did the finance and banking program through TrueLask. Started as an intern at my junior year at an RIA firm in Columbia. Gained 3 really good years of experience there, specializing in helping business owners succeed. And after that experience, I decided that it was time to get back home. And so I made that move, and I was lucky enough to find Correct Capital.
Nice.
And ever since then, I've really been engaged with all of our clients from a variety of different circumstances and crafting personalized plans for them to help them achieve their goals as well.
That's fantastic. So you've invested in education, experience.
Yes.
So what about family?
Family, absolutely. I currently have 4 siblings. And 3 of them are 18, believe it or not. And the last one is actually 5 years old.
Oh.
So we have quite the spread going on for sure.
For sure.
And currently living in Oakville with my family with plans to get a little bit closer to Clayton. So really over the next year, I'm going to make that transition. And, really just continue to elevate within the company is my goal.
Terrific.
Awesome. Well, I'm Ryan Potts. I'm the Chief Investment Officer at Correct Capital Wealth Management. I appreciate you guys having us out today.
For sure.
Glad we got to do this as a group because I enjoy working with these guys. So hopefully some of that passion gets to come through today on camera. A little bit about my background. I'll keep it short and sweet. Similar to Jordan, I've always wanted to work in finances. As a young kid, I kind of looked around and said, hey, who are the most successful people that I know in my life? And it just so happened to be that those folks either worked in finance or owned some form of a business. Sure. So I decided, hey, maybe I want to make a passion in pursuing those things as well. So went to college at Mizzou as well, studied finance and banking, also had an emphasis in personal financial planning. Found out that I really love the relationship side of this business, really love to get involved in clients' personal lives, their goals, their objectives, really find out what makes, them happy and why they want their money to work so hard for them. So really got involved in that. And in college, went back to Kansas City, which is where I'm actually from. Spent a year with the firm there and got a ton of experience. A lot of things happened while I was there. And ultimately, long story short, my fiance and I met at Mizzou, and she's from the St. Louis area. So the good old adage, I'm a transplant, and it's because of a woman. So
what to see about a girl?
Exactly. Yeah. But no, I'm so happy that I found Correct Capital, and then I get to work with 2 great guys here and the rest of our team back at the office. And really, really excited about seeing what the future holds for us.
Yeah, did you pop the question?
I did, actually. Yeah. Last March, we went to Napa, which was, long story short, tied this in as well. Got her a bottle from Napa the first month we dated, and so it was kind of a full circle moment for her. If you asked her today, she knew it was happening the whole time. I still think I surprised her. But we'll see. But yeah, no, our wedding's coming up, and we're really excited.
Congratulations.
Thank you.
Congratulations.
Yeah, and I'm Johnathan Horman. I'm a lead advisor on the team at Correct Capital. Born and bred, grew up in South St. Louis City, Catholic schoolboy, blue collar family. I knew I wanted to be a business major and a finance major because I wanted to learn about how to save and build my wealth, but primarily driven by just being from a hardworking family. Worked very hard in school. Went to Truman State University. I majored in business finance. I had a minor in Chinese. Don't ask me why. So I took Chinese in high school, and there's only a couple of high schools that even offer it in town. So just carried it through college. So I had an East Asian Studies minor. Truman was a great experience. I wrestled from middle school all the way to the end of college, my undergrad. I'm still wrestling to this day.
Oh, wow.
I have a 7.5-year-old son named Elijah, a 5.5-year-old son named Jonah, their beautiful little sister named Lena. It's Leyna.
Oh, cool.
It's part of a Billy Joel song.
Oh, yes.
My world is just filled with blessings. My wife, Laura, beautiful. I'll be married to her 10 years here in May. I'm a part of this team at Correct Capital, and I'm really passionate about helping people, achieve their goals, but also just grow and build themselves up. I had an entrepreneurial streak. I've been in this industry since 2008. I left the industry. I had a business of my own, so helping small businesses comes natural because I've lived that in my day-to-day for over 4.5 years. It was a family-owned business, with my brothers, we just really learned a lot from that experience, and it really relates to what I do at Correct Capital now, helping folks understand what they need for the future, but also achieve it and take the steps to get there. So,
Absolutely. I mean, relationships are important.
yes.
Good, strong family relationships are important. And I think people appreciate that, especially if they're looking with something as intimate as their financial future, sustainability of their livelihood. And it's nice, as I sit with you guys, I feel like it's a really good, positive energy. And this is my personal opinion, right? The viewers can decide however you want. But
We must have fooled you already.
Okay, so yes, you have me fooled, right? But I don't think so. I think Correct Capital's a great organization, and we're excited to have you here. To be honest, because I think if with our ability to reach a greater audience, so that we can spread this opportunity out to more people to realize that when they walk through the doors at Correct Capital, they're walking into a home and welcomed into a relationship, and then with a sustainable future. And I think that's amazing. It feels good. It sounds corny, but I get it. But it does, man, and I think it matters. I think it really matters. So you have to, John, I gotta hear some Chinese.
Some Chinese?
Yeah, dude.
我忘了很多的生词. I've forgotten a lot of words. 我的老师告诉我的发音很好. My pronunciation is good.
Oh, that's awesome.
So
That sounds good.
It's not bad. I like
It's
it.
for real, right?
I have never tested him on that, so
Oh, I had to.
appreciate
Yeah.
you,
I mean, for real, I
appreciate
have
you.
to. Well, let's jump in to just some basics, which is general financial planning. How much money do I need to retire comfortably?
That is an excellent question, and I will go ahead and kick it off here. The answer to that question varies greatly from person to person, and the main driver from what we found in our detailed plans that we form for all of our clients is that if they want to maintain the same lifestyle that they currently live in retirement, then we need to assess the future cash flows of how long they plan on being in retirement, and also what legacy do they want to leave behind when they're no longer here. So, everybody's number is different, and it really depends on their goals for the future. People could either maintain their current lifestyle, they could choose to be more frugal, or they could say, hey, I've worked really hard to get to this point. I'm going to step it up a notch, and I want to be able to fully enjoy the fruits of my labor at this time.
So that number is a variable number.
Yeah, I mean, it varies client to client, but a good rule of thumb, just to simplify it, is probably somewhere, around the 15 times to 25 times what your annual take-home pay is. So, again, rule of thumbs work, sort of like horseshoes and hand grenades.
Yeah, true.
You can go by rule of thumbs, but our process is different. It really is what Jordan said, tailored and detailed to every client's goals and dreams. And we take pride in like the level of detail that our team goes with clients. Whether it's year-to-year cash flow planning or planning for taxes, way ahead of the game. Before the bill comes in April, we're having those conversations with clients. And that's the process really matters. It's not rule of thumbs with us.
It's proactive.
Yes.
I want to jump in there too to piggyback off the process conversation. I think we get that question a lot. It's a very common question. A lot of people want to come to us and say, hey, I've got $1 million. I think I'm ready to retire. What do you guys say? Exactly. We kind of give them that blank stare back like, we need to know a lot more about you.
So you planning on dying in the next 7 years? Is that where you're...
Exactly. No, that's spot on. I think what I always tell folks when we talk about everything in our process, but we need to take it all back to the very beginning. We don't know what your number is going to be until we understand what your goals are. What are you trying to accomplish with your money? What do you want retirement to look like? For some people, it's very minimal. For some people, it's the very opposite. And we need to know these things about individuals before we can comfortably tell them, hey, baseline, if it's 15 to 25 times, or cash flow planning analysis, figuring these things out. We need to have a better understanding of who you are as a person before we can even have that conversation about what's that final number.
Well, yeah, I think it's unclear, right? I mean, to come up with a number and have an understanding of something that you're not familiar with, well, you have to learn what it is exactly that you want.
Exactly.
Yeah, before you can decide what that number would be, which makes sense. But speaking of, to deal with a calamity or to move forward, is it best that you pay off debt first or just start investing?
I mean, we would look at that. It depends on where you are in terms of your life stage. So for some folks, debt might be more important to pay off. Obviously, there's a mathematical answer that makes this very simple. Can you earn more investing than you are paying interest on your debt? Is kind of the simple rule of math. So the example that I always love to give, back in 2021, when mortgage rates were extremely low, a lot of folks refinanced their homes. I think the average national mortgage rate is somewhere below 4% at the moment. For a lot of folks, they're earning a lot more than 4% in the market or in their investing accounts. At one point, you were getting 5 to 6% in a money market. So it would have made more sense in that time period to actually invest the funds. Again, this is purely mathematical speaking. Whereas in a market environment where mortgage rates are maybe closer to 7%, well, if you said, hey, Ryan, you're the CIO, what are your thoughts on the markets? I think I'd be hard-pressed to say over the next 30 years that you're guaranteed a 7% rate of return in the market.
Right.
So in that instance, it comes more of a question about well, what else is going on in your lifetime and what stage of life are you in? Are you trying to accumulate? Are you trying to retire? Are you a stressful person that doesn't want debt? There's a lot of nuances to that question. But again, the mathematical answer is it just depends on what are your rates of return relative to the debt that you're paying on.
Yeah, that question, I mean, it brings to mind a case that Jordan and I worked on this year with a client, pharmacist, high earner, but just a bucket of student loans. And just navigating the complexity of financial math, to Ryan's point, it's not something that is in everyone's wheelhouse. And that's really, truly where we come in, is like simplifying the math so that you don't feel overwhelmed by a decision. And this is a husband and wife that were struggling. They were really wanting to know what the way forward was. And I'll let Jordan kind of talk about like maybe the strategy that we use within the snowball effect or the snowball method.
Yeah, so essentially in our planning software, we have the ability to gather all of the debt information. And as Ryan mentioned, you know, we really prioritize the highest rate debt first because we know over the long term, that's going to be the one that accumulates the most interest that you're sending out. And so the first thing we noticed with this client is that a lot of the student loan debt was private and it was financed at double-digit rates. So the amount of pure interest that this couple was paying on a monthly basis was preventing them from freeing up cash flow for a lot of other things, such as starting their retirement savings, which is pretty essential. So clearly articulating to them that the first thing we want to attack is the double-digit interest rate debt. We did recommend that they refinance since they are private loans. And by refinancing, we were able to clear up hundreds of dollars in their monthly budget that they can use for other things. But really freeing that up allowed them to make larger payments on the refinance loans. And we gave them a timeline saying that if you stick this out and we continue to knock out the highest rate first, you can be debt free in a matter of 7 years when you thought you were never going to make it out of this situation. And being able to give people confidence and clarity, it goes a long way as far as fulfillment and gaining the trust that we look to do in every relationship.
That makes sense. I mean, you walk into it not understanding, and we always see the ending, and it's, you know, which is subjective, and it's all circumstantial, but our endings are different than your endings. And I think that's what's great about getting inside into this world, into a space that makes sense to better understand the situation, so that there's a positive, or there's actually a rainbow here that you didn't realize.
Absolutely.
Follow this protocol, you know. And I guess to clarify the clarity of the question is that, yes, can they be balanced? Can you pay off debt and invest? Can you focus on retirement and continue paying off debt? Is that something that you can balance?
I mean, I would say, like, again, a rule of thumb, and we're not a practice of rule of thumb, so don't think that everything we do comes from this. But I would say it really does make sense a lot of times to balance debt versus investing. You know, debt pay down is a lot more of a short-term benefit. In the example that Jordan and Johnathan just gave, this was a 7-year runway for these clients. But really, starting day one, that first day they made their debt payment, they probably felt a lot better knowing that they were on track to do something. What we also like to do is think further out than just a few years. We want to think 10, 20, 30, maybe it's 60 years if we get someone in their 20s. But the comments there are ultimately, yeah, your dollar today is going to be worth less in the future. So how do we balance out the debt versus investing for your future? Yeah. And ultimately, that's probably the balance is a good combination of the two, because by paying down debt, you're freeing yourself up to do more in the future. And by investing, you're freeing yourself up in the future just from the accumulation of your investments. So again, it's a balancing act.
Yeah, it makes sense. It's a complicated equation. So how much should I keep in an emergency fund?
I mean, I could take that with another rule of thumb. I mean, you hear this often in our industry that 6 months is what you need. But I can also say that from the analytical side, it's much more complicated than that, because everyone's situation's different, and everyone's time that they need the money is different, or time when they need the money is different. Their temperament about investing is different, and the amount of risks that they want to take with their assets. So it's a much deeper conversation when we talk about reserve cash or money on the sidelines to weather a financial storm.
I'll piggyback on that one, absolutely. It is very complicated. It depends on where you are in life. From our perspective, too, just to put some facts behind the numbers, the reason we look at 6 to 12 months of cash in an emergency savings is because on average, that's about how long it takes to replace your income. And so we're thinking about an emergency savings as someone who's currently, 30, 40, 50 years old, employed, still seeking out retirement. They're not quite there yet. If something were to happen to them, something that they can't control, then ultimately that's what the emergency fund is there for. It's to give them the cushion or the comfortability to know, hey, I've got a little bit of a runway here to go and replace that job that I maybe just lost. Or this big expense came up and I had to replace a roof. Whatever the case might be, you want to make sure you've got a buffer of cash there so that you're not worried about market fluctuation and ultimately letting your long-term dollars continue to compound and not interrupt that by all of a sudden being derailed by, an bad situation, right?
So how often should I meet with you to go over my financial plan?
Absolutely. What we like to do with our current clients is we believe that a minimum of 2 touch points a year is really our gold standard, if you will. We realize that for accumulators, it's going to be an entirely different circumstance than a couple that is retired. And instead of worrying about saving, they're worried about, hey, am I reducing my principal? Am I withdrawing at a healthy rate? What are my required minimum distributions this year? Is there an opportunity for me to do Roth conversions? And so what I would say is that for the accumulators that we work with, these meetings are more focused about the next big purchase. What are my optimal saving strategies? How can I be as tax efficient as possible while I'm allowing my net worth to grow? And then on the flip side, when you're working with retirees, it's a lot more in-depth and ensuring that they're receiving the income that they need. We're addressing any opportunities that they have available. I will tell you one of the biggest hot topics that we've dove into recently is the opportunity for Roth conversions for many of our retired clients. And our boss, Brian, says it very well, but as they were growing up in the 70s, 80s, 90s, they were constantly informed that they should do the pre-tax savings. So many of our clients saved a majority of their wealth in the pre-tax traditional IRAs and 401ks. Well, once you get to retirement and you realize that those distributions are ordinary income taxed, you begin to realize that your tax rate is not as low as you were anticipating.
Wait a minute.
And every dollar that you are taking out of your investment funds is adding on to this issue. In addition to Social Security, or if you have a pension, an annuity, all of a sudden your taxable income is just as high as it was when you were employed and earning high dollars.
Well, that's defeating.
It is defeating, and it's disappointing that the tax-free saving strategies weren't as pronounced or well known during that time period. But at the same time, they were introduced more recently, and really that's when it started to take off, was in the 2000s and beyond.
Yeah, I mean, I'll add to that. I mean, what you're talking about there, Jordan, is like an engaged client, and as financial advisors, we have to drive that engagement. We have to create a client service model that makes us different. And what really makes us different is that we're promoting a rhythm in your financial life, whether that is 2 touch points a year, or 2 to 3 meetings per year with your advisor. we're coming to those meetings with some meaningful conversations that can help you promote positive actions in your financial life. So there's a purpose to the madness of us calling on our clients, and having them come in that often. But that engagement is really what makes us different in this industry, because we want to be a higher level of service that is just not experienced in this industry from a lot of our larger competitors.
It seems like, in my perspective, it would be, how long can you neglect not being on track?
It's a great way to put it.
Yeah, how long can you do that? It sounds like 6 months makes sense, just to come back to just check in. And then, you get the pat on the back, and like, you did a great job.
That sounds like my doctor's
You're on
visit the other
track.
day. Yeah.
You're on track. You're taking good medicine, moving money in the right ways. And yeah, it sounds like that's very, very important. And people don't realize that, because it's a financial health.
I was joking about the health thing, but that's
there's a
really
point.
the way we put it. It's like, you go see your doctor at least once a year.
You're
supposed to, hopefully.
Yes.
Hopefully you're seeing them maybe twice a year, depending on
Sure.
the situation. But with your advisor, I think we love to have engaged clients, so we would love to see you at least twice a year. But the reason we want to see you is so we can make sure we have a good understanding of what's going on in your life. Not just financially, but also personally, because a lot of times personal life and financial life are doing the same.
They are.
But it's very important to have those checkups, and being engaged as a client for us is usually a really good thing, because we can add a lot of value in those relationships.
That's important. That's so
I don't know if
important.
you guys want me to talk about what our ideal client is.
Oh, I would love that.
So we do have an acronym. I know it's cheesy, but ideal. We want a client that's intentional, disciplined. They want to be educated about financial things, because it's the depth and breadth of the financial world is vast. I mean, it's a lot. And then we want a client that wants accountability, and we want to drive that accountability so that they can leave a legacy. Now, that legacy is different for different people. It's different. It depends on your preferences. I mean, there's a book out now, Die with Zero. So you could essentially tell us you want a plan to spend everything you got, or you want to leave it for kids or family. So we really like a client that's engaged, and that's really the premise behind Ideal. So
Interesting. But if they're not, so not to scare away anyone that's not ideal, the opportunity to morph into ideal. It seems like everyone would have that opportunity if they're willing.
yeah, I mean, if it's a positive thing, you tell someone they're not ideal.
Well, and it's like, that's the tricky part, right? You can be ideal, you can be not ideal, but then if like the goal is to follow the literal extension of ideal, is that the goal is to get there eventually. You can't do it tomorrow, you can't do it today, but there are so many more tomorrows that you can work on getting into that, into that groove. Here's the your favorite question. All right, how are you compensated? Do you charge fees? Is it based on commissions, percentage of assets? How's that work?
Yeah, so I'll start this one off, and then I'm going to allow them to chime in if any corrections.
I shall defer.
I've got a really good idea of how we're compensated, and that has been really an emphasis of our firm, is that we want transparency on exactly how we get compensated and why we do. And so we have transitioned everything that we do into a flat advisory fee or assets under management fee. And so that allows us to really emphasize our IOU approach, which is that we are independent, objective, and unbiased. And really, to summarize that, we want every decision that we make to be known that it is the best decision for you. And so we are not attached to certain investments, certain companies that are selling specific funds. We have the ability to create portfolios that we believe are going to align with exactly what you're looking for. And through that process, we do select a variety of different fund managers that we believe to be the best in their class. There is no one fund manager that is the best across the board, right? I mean, if there
Sure.
was, everybody would be using that fund manager.
And then they wouldn't be.
Right. And so we have to take an active approach and say, hey, what is, in our mind, the most ideal large, small, mid, emerging markets, all these different asset classes that we're involved with. We proactively look and find those folks that we want to partner with. And, of course, Ryan does an excellent job at managing that. But to get back to what your initial question was, transparency is key, and that's why we want to keep it at a flat fee, directly based on how much assets we're managing on your behalf.
Gotcha. So that makes sense. That's an easy way to understand it.
Transparency, but also making sure the incentives are aligned. So the way that I always like to look at it, it sounds corny, but we're sitting on the same side of the table as the client. So when they do better, we are doing better. That sounds like a Fisher Investments commercial. So, but the whole goal there is again, like our goal is to make sure we're optimizing your wealth and trying to do
Sure.
what we can do, in our best ability to make sure that we're growing the pool of assets that we're helping manage.
Sure.
And that doesn't mean taking undue risks to do that. It just means generally, what's your plan tell us that we need to be doing, and how can we try to optimize that for you? And it goes back to the transparency and just making sure all of our clients understand that when we provide them advice, we're not getting additional compensation for the advice that we're giving. It strictly is based on the flat fee that we've agreed upon based on the assets under management.
Grow together.
Yep.
Yeah, and I just want to key on, like, we're not driven by a product-driven agenda. That we're not motivated, and what that means, it's really the U in the IOU. We are unbiased because of a stated AUM-based fee, so we steer clear of commission products. It is the part of our industry that is it's dying, and thankfully so, because it put an advisor in a position where they would make a decision based on how they were being compensated and to make a recommendation. So, again, commissions are not something that's a part of Correct Capital Wealth Management.
Doesn't make sense. I guess there's a risk tolerance that is negated. So you think you come in and, if they're commission-based on the strategies based on commissions of my earnings, then I would assume they're going to want me to make more money. So, but then in turn, they make more money. Every time you make more money, and it seems like that capitalizes in the wrong direction. So yeah, the flat rate sounds more comfortable, and then trustworthy. You're not isolated, and your stake is not in the wrong place. Yeah, outside of it, in the funds.
Yes, and one more thing I will add there is oftentimes when we are speaking with prospects that we gratefully get referrals from existing clients or whether it be an internet lead that we receive, we often find that they were sold at least one product, if not multiple products, and especially in the annuity or the insurance space, that really don't fit the mold of what they're looking for or their goals. And it makes you question, how is this still occurring in the industry, where we're supposed to be looking out for the clients that we serve, right, and not for our pocketbooks. So it's very nice that we don't take that approach. It makes me sleep well at night. And I can confidently say that when we're giving investment recommendations, it's entirely for the benefit of the client.
It's so good. And there's purity in the intent.
Absolutely.
This is very nice. This is really nice. Well, let's talk about investments and portfolio strategy. What kind of investments would you recommend for somebody like me?
This is always a good question.
Yeah.
And I feel like I'm a broken recorder every time I answer a question. So apologies there, but it just depends is ultimately where I was getting at. However, with that in mind, we take a goals-based approach to portfolio construction. So again, not starting with the portfolio, but really ending with the portfolio. Where we want our conversations to start is with the planning process and figuring out what your goals are for your money. Once we know what your goals are, we can start to align the portfolio to match those goals. The way we think about it, it's called the bucket approach. There's different ways to articulate it, but ultimately for us, it's short-term, intermediate, and long-term, or cash, income, and growth. Right? You align your portfolios using these different buckets to make sure that, again, you don't disrupt the compounding of your portfolio because of something that comes up in your life. We were talking about how much cash you need in an emergency fund. I'll just kind of extrapolate on that a little bit farther to articulate what our bucket approach really looks like. If you have 6 to 12 months of cash in a money market account or somewhere that's very stable, maybe it's your bank, then you know for certain that for the next 6 to 12 months, you have cash that's readily available either for your day-to-day living expenses or, again, for an emergency. Outside of that, you have income, right? For most folks who are working, their income is genuinely what they're making. It's the paycheck that they receive every 2 weeks. But for folks who are in retirement, the income might be the distribution that's coming off of the portfolio. That can be in the form of interest, dividends, capital gains, whatever that might look like. But that's really the income that's being derived from your portfolio. Some folks might know the 4% rule, but essentially if you have $1 million portfolio, utilizing the 4% rule means that we could take $40,000 a year from that $1 million portfolio and your money would last into perpetuity, right? So maybe the income portion is that 4% that's coming off the portfolio. The long-term bucket or the growth bucket are the funds that you don't need within the next decade. And the reason that we utilize a 10-year time frame is because historically speaking, over 10 years, the markets don't tend to show a negative performance over that time frame. Meaning that if you were to invest, in theory, at the top of the dot-com bubble, and 10 years passed, yes, your money wouldn't have grown any, but you also wouldn't have lost any or much at all, right? And so by utilizing these timeframes and focusing on the goals of our clients and lining the portfolio with those goals, we feel like, again, starting with planning, figuring out the goals, and then aligning the portfolio allows us to stick to whatever plan that we've outlined for the client, regardless of what actual investment vehicles we might be utilizing. Again, I threw out a couple there, but bonds, stocks, money market funds, alternatives, we don't really use those, but there's a lot of different investment vehicles. For us, we think about the portfolio as the engine to the financial plan.
Yeah, and I'll just add there, I mean, to Brian's point, the size of these buckets matter. That's why planning matters. And he mentioned the moment the market is in a weak point or in a weak season, that's why they matter. Like, you have to protect yourself for those weak points. I mean, we can all relate to the, buy low, sell high. I mean, that's the old adage that everyone knows about investing.
Sure.
Well, it's simple. That is true. But how do we structure these buckets to do that? And weather a financial downturn, because the hardest thing to predict is how long that downturn's going to last.
Right.
I mean, if you look back even just over the short glimpse of history, the COVID year, 2020, that market downturn was 3 or 4 months long, and by the end of the year, we were up 20% off of a 20% low. If we look at 2022. That was a 9-month downturn before we hit that inflection point at bottom to come up. So that's why sizing matters of those buckets. That's why planning matters. And it's really why financial advice matters, so that we can prevent the panic sell that the client might experience. So, yeah.
I want to take a second shot at this too, by the way, just because I think I talked about goals. but I'd want to use a real world example of exactly how we implement this. So without using names, I'm just going to think of a client that we've all worked on together, who's in their 40s, recently left a job, but they're looking to build a brand new home. It's a beautiful project. It's really exciting time for them. But the question ultimately for us was, hey, Ryan, Jonathan, Jordan, right now my entire portfolio is 100% in the stock market. Does that make sense? And through our financial planning process, we uncovered that they had these goals such as building this brand new home. We also uncovered that he was no longer employed and looking to start up a business, right? And so we need to take that into consideration as well. Ultimately, what we decided upon was, hey, let's take some of the funds out of the stock market, put them into a more conservative investment that aligns with the time frame of you wanting to build this home. Because there's no builder that you're going to be able to go to, no lender that you're going to be able to go to and say, hey, I've got money. It's tied up in the market.
Yeah.
Right? They want cash. They want more secure investments. And so that's what we did. We built the buckets saying, hey, here's cash for 6 months that kind of gives you a runway as you start up your new business. Here's your bond portfolio or more conservative portfolio that's going to align with when you look to start that project to build your new home. And then everything else, these are young folks, everything else is still for retirement. It's still for accumulation. So leave it in the market and let it continue to appreciate.
Yeah,
right?
such a good example of when a rule of thumb does not work.
Yeah.
And that client is such a great example of that. Because if he would have just went and got the cookie cutter advice, it would have been like, oh, everything should be in stocks. You're 40.
Yeah.
So, I mean, what a great example. So.
The industry talks about things like investment vehicles, buckets, and how do you determine my risk tolerance?
I'll tackle that one. And again, we're a detail-oriented shop. We care a lot about our process and how we ultimately get to these kinds of things. I would say first and foremost, the industry standard is more of a conversation. It's some arbitrary questionnaire that you're going to fill out. And then based on how you answered that questionnaire, coupling that with the advisor's conversation, they're going to tell you, the client, oh, that sounds like you're a moderate aggressive investor. Well, Scott, your version of moderate aggressive and my version of moderate aggressive, probably two different things.
For sure.
Who knows, right?
Right.
I have a passion for this. I've done it my whole career. Maybe you're not as interested in it, and so for you, it's like moderate aggressive. That seems kind of risky out, I'm not sure. We tried to move away from that. So we've incorporated new technology into our process that allows us to truly quantify what your risk tolerance is. And so it's a similar questionnaire like the one you would have taken back in the day on paper. Answer this 1 through 5 based on your numbers, add up the numbers, and that kind of tells you where you fall. The beauty of our technology is essentially that you answer the questionnaire, Scott, let's say it comes back at a risk score of a 60. Well, that's a quantifiable number. You can feel good to know that your risk tolerance is a 60. The question you probably have for me is, Ryan, what does a 60 mean?
Sure.
Which is a fair question.
What's an INFJ?
Exactly. The beauty of what we do with our technology is we can take your risk tolerance through our questionnaire, quantify your risk, and then align a portfolio to that risk score.
Oh.
So if you scored a 60, for instance, in the example, we could go out there as advisors and build you a portfolio that has a 60 risk tolerance. So now you can look at it and say, hey, I'm a 60 risk, and you guys have presented me a portfolio that's scoring a 60 on the risk score. So now your risk tolerance and your portfolio risk are actually aligned versus the before conversation, which was, I think you're a moderate aggressive investor, and you look at me and say, okay.
What does that even mean?
Exactly, right? And me as the advisor, I kind of have the subjective ability to say, well, this is what it means. And from advisor to advisor, it means something different.
It's like the variability in the gray of how much is moderate, how much is aggressive.
Exactly. We're trying to eliminate that in our process, and that's really where this technology comes into play. So yes, it's still a risk tolerance questionnaire. You're still filling out answers, but based on those answers, you're being given a risk score. The advisor and you are going to deliberate and make sure that score makes sense for you.
Sure.
And then we can sit there and build a portfolio using that score, turn around and show you a proposal. We love doing this because it's such a cool exercise. Showing them a proposal. Here's your portfolio that we've constructed. Here's how it's a 60. And now they know, great, my portfolio is right in line and the expectation was set early on about what I can experience. Right.
Fantastic.
So that's really the process. Yep.
Yeah, I mean, I'll add to that. I mean, I know I keep going back to why planning matters.
It's important.
I mean, planning matters in this case too, because it's not just about the scientific approach of some software that gives you a risk rating. It's also about risk capacity, and we talk about this a lot in the offices. And when you weave the planning details, the short-term cash needs or the short-term home improvement needs or car purchases into that risk score that we get from the software, we can now make a more qualitative and quantitative recommendation on where your portfolio actually needs to sit. I know this is going to be cliche, but there's an art and a science to everything and every decision in life. And we really play on both sides of that. We have the art, we have the ability to understand your situation, but we have the technology to really deliver value to clients.
What's the difference between stocks, bonds, mutual funds, ETFs?
Yeah, I'll tackle that really quick. So ultimately, a stock is representation of ownership of a company. So I'll use Amazon as an example. If you own Amazon stock, you are technically an owner in the company Amazon, right? Bonds represent debt, either of a company, an entity, a government, really a lot of things, but it's just a representation of debt. The stocks vary, they move up and down kind of depending on what the business is doing. A bond is pretty, not guaranteed, but close to it. When you buy a bond, it might say you're going to earn a 4% yield. That means you're going to earn 4% on that bond, right? There's more nuance to that, but at a high level, that's the difference between a stock and a bond. A mutual fund and an ETF are essentially the same thing. And the way that I always like to describe it is if that stock Amazon was one slice of a pie, a mutual fund or an ETF is just the full pie, right? So you might have 12 to really it's usually hundreds of different slices of that same pizza or pie. But the mutual fund and ETF are just a grouping or a basket of individual stocks or bonds.
How do I protect my portfolio from market downtimes?
Yeah, we've touched on it already a little bit today, but the bucket approach is really what's most important for us. So incorporating cash, income, probably using bonds in this instance, and then allowing your growth bucket continue to ride out the markets.
What's the best strategy to rebalance my portfolio?
Yeah, we like to take the guesswork out of rebalancing. A lot of folks think that there's a magic wand that they can, time their rebalancing procedures. The way we like to do it is a very systematic approach. So every quarter we look to rebalance. Typically what ends up happening though is based on market movement and fluctuation, we might actually only trigger buys and sells twice a year. So for us, it's a quarterly cadence. Again, this just takes or eliminates the guesswork out of it. And it's ultimately the reason you rebalance is to keep the portfolio in line with your stated risk.
Another important topic for folks out there wanting to learn about, their financial health is retirement planning. So when should I start saving for retirement?
Immediately. No, I mean, it makes sense to speak with an advisor and develop a plan because to my point there, you need to start right away because every second that you lose with inaction is another day that you'll have to work beyond your goal retirement date. So it's really important. Now it's different. So if you haven't had that conversation and you're approaching, your 50s, mid 50s, you need to get in and see a planner and get a clear picture of what it's going to look like. What is your retirement income check going to look like? So if you're close to retirement, 1 year away, you have some time to really develop a plan. But yeah, you have to start right away.
How much should I contribute to my 401k, IRA?
Yeah, so I'll take this one. We always recommend that if your employer offers a qualified plan, such as the 401k, 403b, 457, whatever that is, you always want to take advantage of the full match that they're offering. The The reason for that is because it's essentially free money for you, that if you do not contribute up to the full match, you're losing on an annual basis what they'd be putting in for free. And so that's always the first step that we check for to make sure that they're taking advantage of that. Second step is that if there is room for additional qualified savings, we want to determine if you can make direct Roth IRA contributions, or if your income is above a threshold, then we would recommend doing the traditional IRA, or even in the taxable space with the brokerage account. Plenty of different options out there.
What's the difference between a 401k, traditional IRA, Roth IRA? Seems like there's a lot of options.
Yeah, to give a summary of the main differences, a 401k or 403b is a qualified employer-sponsored plan, and the contribution limits are different among the qualified employer plans and then your traditional or Roth IRA. There is no income limit on qualified employer plans. So despite what you're making, you can make the full contribution to either pre-tax or Roth in those plans. On the flip side, there are income limits for the contributions that you can make directly to a traditional and a Roth IRA. So the employer plan has that income benefit where you are not subject to limitations on what you can contribute, and the amount you can put into employer plans is always going to be higher than what you can put into IRA accounts.
What are RMDs? So correct me if I'm wrong. I think it's required minimum something.
Weapons of mass destruction. No.
Is that what it is? And then when do I have to do it? When do I have to take them?
So for the RMDs, the required minimum distributions. Yeah, that's
it.
we hear RDM a lot from those that we're talking, but those begin at age 73 if you were born on or before 1960. If you were born after 1960, those begin the year that you turn 75. What those are essentially is that the IRS is going to make you begin taking distributions from your tax-deferred dollars. So typically it starts at around the 4% mark of the entire balance of your tax-deferred assets. And then each year that amount increases slightly based on mortality tables and calculations that they run. Once again, we've hit on this, but that's a big reason why we do Roth conversions, because we want to take the tax-deferred money and transition it to tax-free in the Roth space to reduce the amount that you're required to take when those RMDs kick in.
What are the benefits of a 401k rollover?
Yeah, I can take that one. You have options when you leave an employer. You can take a lump sum distribution, and don't do that without talking to an advisor. You can keep it in the plan, which you're only you have certain investment choices. So there's lack of flexibility inside the plan, or you can move it to an account with an advisor, and have it professionally managed. And you're offered way more flexibility in investment choices when you move it out to an IRA account, rolling it out of the retirement plan with your employer to a firm like Correct Capital into an IRA or Roth IRA, depending upon where it was sitting in the plan at the employer. So again, it really is about flexibility and the opportunity to get advice and understand and be educated about what your options are.
If I leave a company, should I take my 401k with me, or does it go with me?
Yeah, to address that question, we mentioned earlier that we always take an unbiased approach in the advice that we're given there. And so the first thing we would want to assess is your current investment in the company that you've got that you have left. And based on your investment allocation, the other investment options they have available, along with the fees that they are going to continue to charge you for leaving that account with their firm, we would determine at that point if there is enough investment flexibility and the firm itself is a strong, reputable company. That would help us determine if it would be worthwhile for you to leave your plan with them, roll it into a new plan for the new employer that you're joining, and really getting that balance transferred so you can continue making contributions. Or is it in your best interest to roll it into traditional or Roth IRAs to open up the investment landscape flexibility to the entire marketplace rather than being restricted with what offerings they have within their company plan?
Should I invest in crypto?
That's a tough one. No. Should you invest in crypto? I think you need to ask yourself, why do you want to invest in crypto? Is it because it's done phenomenally well the last 10 years and everybody looks at that and says, hey, just because this thing's gone up 20% per year, I think it's going to keep going up 20% per year? Because if that's your reasoning, I don't think you should, because the outcome's probably not going to be as rosy as you think it will be. If you want to invest in crypto as a diversifier in your portfolio and you want to have something that is maybe outside of the bounds of normal finance, maybe it's DeFi, that's a really popular term, then maybe it does make sense as a diversifier in the portfolio. We tend to stick to the recommendation for our clients that it doesn't necessarily need to be a part of the portfolio. We feel like we can earn attractive rates of return elsewhere throughout the market. If someone does want to have that exposure, we tend to tell them, look, we don't want to take on too much risk to get exposure to crypto. So the way that we would incorporate it into the portfolio is by a simple allocation. Maybe it's 1 to 5% of your total portfolio value. Again, as a diversifier, as something that is meant to look and feel different than the rest of your portfolio, not as something that we think you would make 100% on per year for the next 5 years.
What's the company's, when it comes to risk tolerance, what's Correct Capital's stance on crypto or ETFs, or, we can dress it up, and, oh, it's okay if you want to, but what's the real viewpoint that people need to understand about crypto and ETFs?
Yeah, cryptos are definitely, from our standpoint, from our perspective, policies that we have in place, buying directly crypto securities. So think about going and opening up a wallet on a group like Coinbase. We're not doing that for clients. We're not recommending clients go and do that. The way that we get exposure to crypto is through ETFs, exchange-traded funds, that are somehow getting an underlying exposure to said crypto. I think Bitcoin is the one that most people are familiar with. It's been around the longest. It has the most traction. There's Bitcoin ETFs out there. We have clients that make allocations to these Bitcoin ETFs. But again, the firm Correct Capital Wealth Management does not recommend cryptocurrencies to most of our clients. But that all has to go back to our process and the reasonings why we own certain things in our portfolio. It's not so much we're anti-crypto. It's just more or less, can we achieve your goals and objectives through a less risky vehicle? And
Sure.
the answer tends to be yes. So we feel like we don't need the exposure.
So that's on an average risk tolerance. Crypto tends to be a lot higher on the scale of risk tolerance, or lower, I should say.
Much higher on the scale of
How
risk.
does that level work anyway?
Exactly.
Right?
Yes, so most cryptocurrency exposures or investments are on the riskier side. If you just look at historical volatility, which is a fancy way of saying how much does it move up and down, it tends to be much larger than your typical investments like stocks and bonds.
Sure.
Yep.
Well, here's an important question. do I have to have a minimum asset base to go to Correct Capital?
Yeah, that is a great question and one that we encounter pretty often as a firm. And really, the way that we look at it is that we do, of course, want to be able to serve the vast majority that are looking for our services. In that same breath, there are times where lower asset individuals that are in early accumulation phase wouldn't get the full experience or value that we can offer as a firm. And so through experience over the years since the firm was founded, we have really set our target at a threshold of $500,000 as being a true level where we can come in and add tremendous value through the planning side, along with the investment management process. With that being said, we do have the opportunity or the ability to work with cases on a subscription basis. But oftentimes, as I mentioned, we find that we can steer them in the right direction if they are under that asset threshold to achieve their goals without the need to pay an advisory or an AUM fee. And as they navigate life and they become more established, we find that we can offer more value once they hit that threshold to help enhance their plan and their situation.
That makes sense. Do you guys service just locally, or do you offer services nationally?
Yeah, I mean, since COVID, really, and the everyone's Zooming or using Microsoft Teams.
Yeah.
I mean, technology is just expanding every day, every minute. So I mean, we are effective at servicing clients all throughout the U.S.
Oh, wow.
And it's really driven by our process, but also how we can ensure that your money is good with Correct Capital is our partner with Fidelity as a custodian and a record keeper of your assets. So if you open an account with Correct Capital, it's with Fidelity. And it's, we are an independent advisory firm, but having a company like Fidelity behind us for accounts and things like that really gives clients a sense of confidence and clarity that they can use us for all of their financial needs.
The market like it is, and it seems like it's undeclared. Maybe it's a little, people are unsure. It's a good question that comes up often when people are reaching out to us about you guys is, should I invest in stocks and bonds, or should I buy just gold and silver?
You'd be shocked how often that comes up in conversations.
Really? Yeah.
Yes. I think this kind of plays a little bit on our conversation about Bitcoin earlier. Is it a good diversifier in a portfolio? Yes. That's just proven over time in history. There's periods of time where stocks and bonds don't do as well as gold and silver. But historically speaking, and really what drives our investment process at Correct Capital Wealth Management is one that's rooted in evidence and fundamentals. We really take a long-term approach to the way that we handle our clients' money. So what we don't do is chase short-term fads. Right or wrong, that's just the way that we operate. What we want to do is make sure that our clients stay the course and are invested for the long term, because at the end of the day, all that matters is that they stay invested. The problems with gold and silver, there's not a whole lot of fundamental reasons as to why you should always own gold and silver in your portfolio. Those reasons might change. The benefits come and go, right? There's periods of time where those things can drastically outperform just the general markets, but there's also extended periods of time where they drastically underperform. And that is what I call risk, right? The risk of being wrong for a very long period of time, or just the risk that you might have gotten lucky on your timing, made some money, but ultimately that's not consistent and something that you can hold your hat on moving forward. So instead, what we would do is we would say, let's focus on the stocks and bonds where we understand the fundamentals that drive returns over the long term, other than someone else is willing to pay a higher price in this, for this thing that I own. And we continue to own a diversified basket of stocks and bonds. And yes, once in a while, when a client asks that question about gold, we're comfortable owning it in the portfolio, but it goes back to my comments earlier. Why are we owning it? What are the purposes? And if it's for diversification, by all means, we can incorporate it into the portfolio. If it's for the sense that, hey, it's gone up a lot recently, the answer is no, because the likelihood that you're on the right side of that trade is very low.
So the truth in it is, if you think gold and silver is a tangible, protected, hard asset, it's really just as testy and risky as the market.
Right.
Right. This is interesting.
Absolutely.
Interesting fact, because you think, well, I have this, these bars, right? I bought a storage unit.
Well, it's funny you bring that up, actually, because I do want to touch on that.
Yeah.
That is typically the answer that I give to most folks.
Really?
If they say, hey, should I invest in gold or silver? I ask them, would you be willing to buy the physical gold or silver, store it in your house, hold on to it for 20 years, and eventually whatever price it's at in 20 years, you sell it, right, if that's the case? And for most folks, they look at that and say, probably not.
No.
I'm like, okay, well, that's what you're doing by putting it in your portfolio. It's the exact same thing, essentially, but you're getting a lot more volatility through a public wrappered vehicle. And so, again, it goes back to, would you go buy the physical bars of gold themselves, hold on to them in a safe at your house for 20 years, and be comfortable knowing that the value in 20 years is going to be worth the wait? And most folks come back to me and say, probably not.
Yeah, no.
Yeah.
I'm pretty much on that too. I would be the same. Like, no, I'm not gonna. Where am I gonna put it? I wait till the kids are 18. Maybe I kick them out. I could put it in their room. Well, let's talk about taxes and insurance, which is a pretty important subject. How do I minimize my taxes on investments and retirement income?
Yes, to address that question, it's really comes down to the level of income that you're currently earning, especially in the accumulation years. There's a certain threshold of income that determines whether you'd be more advantageous for you to contribute pre-tax and reduce your taxable income in the current year versus making a tax-free contribution and actually paying the taxes in the current year to experience the tax-free growth for the rest of your life. And as a general rule of thumb, if you are in the 24% marginal tax bracket or below, and you have over 10 years that you're going to be invested without taking distributions, it's likely advantageous for you to consider making Roth contributions, going ahead and paying the taxes now so that you can experience the tax-free growth for the remainder of your working and retirement years. So that is sort of a rule of thumb answer. But of course, if you have an opportunity in retirement where you're not going to be making much income, you can once again do the Roth conversion strategy and convert that pre-tax money into tax-free money at a much lower rate than you would have been able to in your employment years.
Yeah, and I mean, from a high level, I mean, to really get ahead of that conversation, I think, clients need to recognize that there is a disconnect between the party, the CPA or the EA that files your taxes, and your financial advisor. And finding a way to communicate and connect those two parties in our industry is really where clients need to sit and decide how they're going to be proactive about that. So starting that conversation early in the year so that you can get ahead of the tax bill in the following April. So we're talking about 12 to 13 months of time that you really have to be proactive about it to connect the dots and understand where you might land in April of the following year. So
that makes sense. What kind of year-end moves can I make to minimize my tax burden?
I can take that one. I mean, first step, get ahead of the year-end conversation. Second step, speak with your advisor to understand your year-to-date tax summary. Where do you sit ordinary dividends-wise, interest on the account, and realized capital gains? And then taking a look at your portfolio to see where there might be opportunity to realize losses on certain positions that will offset gains. That's a concept called tax loss harvesting. It's a real flashy buzzword in our industry, but it is quite simple to really have that conversation. Year-to-date tax summary. And this data is readily available with the firm that you have your investments with. And we're able to have those conversations and make the information meaningful so that we can make decisions at year end. Again, all the head off that tax bill in April.
What's the most important thing about managing the liability of tax? What's the most important thing you could tell to a client?
Taxes are inevitable. I think that we always have this conversation about, taxes are looked at as a bad thing. And that's not to say that they're not annoying. They frustrate people, but also it means you're making money. And the way that we navigate the tax burden or the liability is just to make sure that the information is accurate, that you're working with a team of not only your advisor, but a CPA or an EA to help you file. Also making sure that you are comfortable with the idea of paying some tax, because at the end of the day, again, paying tax means that you have made some money, which is never a bad thing.
No, never. Let's get into estate and legacy planning. Do I need a will or a trust? And what's the difference between the two of them?
Yeah, I think the answer to that question lies in the complexity of your situation. And that, unfortunately, that boils down to the amount of dollars that you have. So, at a most basic level, you do need a will, a power of attorney, health directives power of attorney, or medical power of attorney, and then titling assets appropriately for the simpler cases. You don't necessarily need a revocable trust, but titling assets with transfer on death or payable on death agreements. It's common on bank accounts, but a lot of clients don't realize they can do that on their investment accounts. That eliminates the need for a revocable trust. But once you get into the more complex asset levels as you go up the spectrum of affluency, that's when the more complex estate planning considerations and trust and the type of trust comes into play. Also family dynamics. It doesn't just rely on complexity. It's also, I want my son or daughter to have these assets, but what are they going to do with them when they get them? And what if they got them now when they're 20 instead of when if I die soon or die early, or because that's a much different. How do we protect for that scenario, but also protect for the scenario or plan for the scenario where it would be a normal. I passed away in my 80s, because also family dynamics, brothers, sisters, there's divorces, remarriage, things like that, where those come into play. And we're there to navigate those conversations with clients about estate planning and legacy.
And there's got to be a way to differentiate, to understand very simply, a will does what? And then if you have a trust, how does that make it different? Meaning, you mentioned there's intricacies, like you can establish specific processes on how the money is distributed, and then, so a will, just plainly, right? If I wrote a will, what happens?
The key thing that the will is doing is it's a bequeath. It's telling folks and legal parties, judges, the courts, where you want your assets to land and how. But it doesn't avoid probate, for instance. So that's what we're trying to avoid, is the stressful situation that only amplifies family dynamics after your passing. So having a plan for that, and that's why I say that it goes one step further than just having a will. In the simpler cases, it's titling accounts effectively. And the more complex, that's where you bring in the more complex, I need a trust, and what type of trust. So
How do I make sure my family's financially secure? If something, God forbid, happens to me.
I could take that one as well, because it really hits on insurance and why you would need it, especially life insurance. The premise of life insurance is protection, and you're trying to protect income making ability. So understanding if something happened, and this primarily is a conversation that we're having at accumulators with accumulators that have children, and the husband. What do we do if I pass away? And it boils down to, if you have debt, do you want your wife and kids to be debt free? So paying off the house is a typical thing you would cover with life insurance. The other thing is, how long might you want your family to go without you after your passing? How much income would we have to protect, and how many years is that? So if you're a $100,000 or $200,000 a year earner, and you want to protect your income for 5 years, it's $1 million in life insurance protection plus the debt payoff. So if it's $600,000 house, we're at $1.6 million in coverage. So, and our focus is more asset management and investment planning, but we do want to make sure our clients are protected. So, cash value life insurance, we prefer term over cash value, because we can provide protection and really help on the investment management talk for the future.
To take that a step further as well, just going back to our process and how important our process is, by getting to know you as a client, uncovering what needs you have, what we ultimately do then once we've kind of solidified a financial plan for the future. The next step to that process is ultimately stress testing that plan and making sure that if something were to happen to you, that your family was going to be financially secure. And that might be incorporating insurance where it makes sense. We're not insurance sales folks. We don't represent an insurance company. But we do want to make sure that if insurance were to make sense as the ultimate catch-all for a terrible situation, that it's there for you and more or less your family that's left behind. Sure. Also, on top of that, making sure you have a second set of eyes looking at all your beneficiaries, making sure that everything is in a line to your wishes. Because a lot of folks, something like this happens and they don't know until it's too late that mom and dad's accounts weren't titled correctly. So now the kids have to go to probate, pay additional fees to receive funds that were actually theirs, or whatever the case might be. But again, it goes back to our process and making sure that we're constantly looking out for things that most folks aren't considering.
Let's talk about business and employer plans. What retirement plan options are available for a small business?
Yeah, I could take that one. I mean, in its simplest form, there is the simple IRA plan. You then move up the lineup there. For a sole business owner, there's things like solo 401k and the creation of a sole owner cash balance plan or defined benefit plan. When you take on more employees, you have the plans like 401ks for small businesses. Where there's more than just one employee. And then there's other ways for businesses to help their employees save for retirement. There's 457 plans in government entities and nonprofits, the 403B. So we're there to navigate these plans with employers. We can really act as in a more custom fashion. So we're a smaller firm, and we have many partners that we can rely on. So really be the partner to help you design a plan that makes sense.
How do I set up a retirement plan for my company?
Yeah, I mean, that process starts with, talking with a firm like Correct Capital, and us really understanding your goals and your financial situation, especially on the business side. Can your business afford to make contributions to a retirement plan or not? Because the recommendation changes if, on what you can afford to actually contribute. The reason why you would do it is because of the higher contribution limits that it gives participants, not only for the owner of the business, but also for the folks working for them. It's a retention move to keep employees engaged in working for that firm. So there's a lot of things to consider, but we have the resources and the knowledge to really help businesses in this regard.
How do I cost manage providing that opportunity to my employees?
Working with a third party really helps in this regard. A lot of business owners don't understand the cost of servicing a 401k or retirement plan for their employees.
Right.
What I would say is a group like ours, we partner with entities that provide us proprietary knowledge around what the average fee would be for an employer to start a 401k. And the way that we price most of our engagements on this side of the business are, we want to be fair, we want to be transparent. And so we use this proprietary data to say, hey, on average, a firm like yours, maybe it's a 20-person marketing shop.
Sure.
Yeah, we would say, hey, on average, that type of business is paying roughly a 1 to 1.5% fee to offer that type of 401k plan to their employees. So we would turn around and offer you a solution that is either similar or better in pricing, so you understand as the owner that you're getting a good deal out of all this.
Well, how do I choose the right 401k provider?
Yeah, I think it's one that differentiates themselves by the education programs that they give employees that will be in the plan, offering, personal financial planning as a part of the engagement that the investment advisor has with that plan. So that's one side of it. Again, engaging with people and understanding their goals, dreams, and desires. But the other side of it is how do we keep track of this thing? How do we pick a third-party administrator? Because you need one of those as well. You need an investment advisor, third-party administrator, and a record keeper. So there's 3 parties at play and the business. So it's, navigating that complexity and having options. And also having options that make sense in today's world. Briefly, I mean, a lot of employers just go right to their Paychex provider. You got Paychex, ADP, and they blindly go into these plans without a detailed discussion. And it goes back to our process. We are going to discover your needs before we recommend.
How do I improve employee participation in our retirement plan?
I mean, education is first and foremost. Most folks don't know that they can contribute to their 401k retirement plan. Most folks don't understand the benefits of contributing to a 401k retirement plan. And to be frank, most folks just aren't saving for retirement in general. And so if you can work with and partner with an advisor team that is able to go out and be in front of your employees and educate them on the benefits, the why, the how, the when, because some folks maybe start electing and then realize their paycheck just got reduced, right? So there's a lot of intricacies there, but it's ultimately an education exercise with your employees.
Do you find that more educated employees are more likely to invest into my company's 401k plan?
Yeah, the more educated the employee, there's direct correlation to answer your question.
Okay.
The more the employees are educated, again, on what a 401k plan is, how does it operate, and when does this occur, when do the contributions actually happen, the more likely they are to participate in the plan. A side note for business owners, the more educated your employees are, the more likely that they're going to retire on time. That's very important when you think about the cost structure of a business. When you have older, more elder employees who have been around for a very long time, as most business owners understand, those are very expensive employees to have. Not saying the quicker you can get them to retirement, but the better you can help them get to retirement tends to be beneficial for both parties.
How do I benchmark our 401k plan fees and performance?
Yeah, I think that it comes down to being open to the conversation. It's really easy and simple for us if you give us some simple information like your plan document. That's a crucial piece of information, and your current cost structure, so that we can take it back and then give you an objective, evidence-based evaluation of your current plan. And if you don't have a plan, we have the resources. It's the Retirement Plan Advisory Group. So we're a part of an organization that helps us deliver value to small business owners and even mid-sized businesses. Again, it's all about engaging in the process and really seeking to find the answers that you're looking for.
We're so grateful to have you guys. I mean, this is such a tricky subject for so many people and so many businesses, and designing the right goals and the process that provides the aptitude to find the way to make those goals come to fruition, the education, you guys are a part of a family at Correct Capital, and you have families at home that create a connection here, a cohesive connection that I can sense. And I'm grateful that we're able to sit with you. I'm grateful to be able to share the knowledge and to offer, those that can have the opportunity to view this, to see what you guys have to offer. And I'm hopeful that this does grand things so more people realize that. It's a wonderful way to reach the community with more than just an offer. It's like we're reaching out with, this is a relationship, and they may be going in perspective blind, but it's nice to feel like, I think in my opinion, in the case of going into situations like this, is to feel like if I go in, then I won't be blind anymore, which is nice. It's really nice. So I'm grateful. Thank you so much for joining us. So we'll see you next time on Hexton Studios. We got Correct Capital with us today. Trust matters. Thanks.